Good afternoon. Would you please call the case?
Our case this afternoon is Robert Half International, Inc. and Subsidiaries 180111756.
Thank you. Good afternoon. I want to welcome the parties for coming today. I know it's taken a lot of steps to get to this point, and I appreciate all the efforts that have been taken, and I understand the importance of the decision to be made on this appeal. I am John O. Johnson. I'll be the lead administrative law judge for today, and the decision will be myself and my co-panelists, Judge Njija to my right, and Judge Gass to my left. And I'll ask the parties to introduce themselves, starting with the taxpayers' representatives.
Anthony Fuller with Deloitte, representing the appellant Robert Half International.
Joshua Grossman with Deloitte, representing appellant.
Mark Giamatti, Robert Half International.
And the representatives for the Franchise Tax Board.
Melissa Williams with the Franchise Tax Board.
Craig Suiso for the Franchise Tax Board.
All right, thank you. And for the appellants, is there a lead attorney that will be taking charge of most of the discussion and giving the opening statements I should address questions to, or just appellants in general, and you'll figure it out?
I will be the opening. Mr. Grossman will provide significant portions of the middle, and then I will end it.
Okay, thank you. I'll try to direct my directions as far as procedures to you, Mr. Fuller, but questions may come just to appellants in general so that anyone can answer on your side.
Perfect.
And Ms. Williams, you'll be responsible for the statements for the Franchise Tax Board as far as arguments?
Yes.
Okay, thank you. We're doing a little bit of off the record here to just get ourselves started, figure out the procedures, and make sure everyone's comfortable with what we're going to be doing when we go on the record. Just want to make sure we have a clean and efficient hearing. And first off, we'll go through what we discussed at the pre-hearing conference as far as the actual mechanics of the proceedings. We're going to start with appellants going to have 30 minutes to provide their arguments. Franchise Tax Board will have then 30 minutes, followed by 5 to 10 minutes for rebuttal for appellant. We'll have questions from the panel if we have any, and then after that, both sides will have 2 to 5 minutes for closing, starting with Franchise Tax Board, and then appellant will go last. And these are all estimates. If you only need 20 minutes, just take 20 minutes. Don't feel like you have to fill out the time. And if you do have any questions along the way, please feel free to interrupt me. Let me know that something's not clear or you think I've skipped something. Don't worry about it. Just let me know. Interrupt me, and we'll get it figured out.
I'm hearing impaired. I have a cochlear implant. Could you have the microphone more directly in front of you, please?
Sure. I don't know if that's...
Thank you.
Is that better there?
I appreciate that.
Okay, great. Sometimes it's hard to hear myself through the speaker as well. Thank you.
Thank you.
And also, a fair warning, I may interrupt you if we start getting off track, so it goes both ways with me and the parties here. As I mentioned, I'm the lead judge, but there will be the three of us up here on the panel that will be deciding the appeal today. Not today, but we'll be deciding the appeal that we're hearing today. I do want to point out that the Office of Tax Appeals is an independent agency. We do not communicate with either party, ex-party. If we have any communications with the party, such as briefing, we do give copies to both sides. So everything that we have is what's been provided on briefings and what we'll have here today to decide the appeal, and both parties have been given a copy of everything. The sole issue I have on appeal is whether the value-added tax imposed on the provision of services should be included in the sales factor of the apportionment formula. Does that sound accurate, appellates?
Yes.
And Franchise Tax Board?
Yes.
Okay. And I would note that when the appeal was originally brought in, there was a question of the 2007 tax year was taken in with jurisdiction as an issue, and the parties have clarified that 2007 is not before us, it's just the 2008 tax year.
Correct.
Correct.
Yeah. And also discussed during briefing was the question of alternative apportionment under 25137, but my understanding is that there's no argument that there's 25137 distortion under these facts, and that issue will not be discussed today. Is that correct, appellants?
Correct.
And Franchise Tax Board.
Correct.
Thank you. The next matter is the exhibits. We distributed an exhibit log and package of exhibits to both parties. And I'll just go through that quickly. We have exhibits 1 through 17 for the appellants. I would note that as we discussed at the conference, I wasn't going to include Exhibits 13, 14, and 15. These were briefing matters. They were more arguments than they were actual exhibits. So those will not be omitted, but if at any time you feel like you need them as exhibits during the proceedings, let me know and we can discuss it then. I note that Exhibit 16 were sample invoices that were provided within the requested time before the hearing. Franchise Tax Board, you did not provide any brief on those. We didn't ask you to. Did you have any questions or objections to that exhibit that came in, the sample invoices?
No.
Okay. And did you have any objections to the rest of appellant's exhibits?
No.
Okay, thank you. Respondent, you have Exhibits A and B. Those both came in with your reply brief. And appellants, you had no exhibit or no objections to those exhibits. Is that right?
Correct.
Okay. And then we also have the Exhibit J1, which is joint statement of facts from both parties. Appellants, did you have any additional exhibits that you want us to consider today?
We do not.
Okay. And respondent, same question?
No.
All right, thank you. I will have everybody reintroduce themselves once we go on the record. I'll admit the evidence, and I will restate the issue again once more. If at any time during that sort of reintroduction of everything you think I missed anything or I'm not accurately representing your positions, please let me know. But do you have any final questions before we go on the record, appellant?
No.
Okay. And Franchise Tax Board?
No.
All right, thank you. Hearing none, we'll now go on the record. This is the appeal of Robert Half International, Inc. and Subsidiaries. It is case number 18011-756. It is 1:05 p.m. on June 25th, 2019, here in sunny Sacramento, California. I am the lead administrative law judge for this hearing, John O. Johnson, and let me say good afternoon to my fellow co-panelists today. Good afternoon, Judge Ajija, and good afternoon, Judge Gast.
Good afternoon.
The sole issue on appeal is whether value-added tax imposed on the provision of services should be included in the sales factor of the apportionment formula. This is for the 2008 tax year. The exhibits that we are now going to admit into the record include appellants exhibits 1 through 12, 16, and 17, respondents exhibit A and B, and exhibit J1, a joint statement of facts. Appellants, we're going to start with your arguments. You will have 30 minutes. Did you have any questions before we begin?
We do not.
Okay, when you're ready, you can start.
Okay. Your Honors, are we introducing ourselves initially?
Oh, sorry. Yes, please. How the parties introduce themselves.
Anthony Fuller with Deloitte Tax, representing appellant Robert Half International.
Josh Grossman with Deloitte Tax, representing appellant Robert Half International.
Mark Giamatti, VP of Tax, Robert Half International.
Thank you. And we'll have Franchise Tax Board, while we're at it, introduce themselves again.
Melissa Williams, Franchise Tax Board.
Craig Suiso, Franchise Tax Board.
Thank you very much. You may begin.
Your Honors, thank you for your attention to this matter, and we do appreciate the opportunity to speak before you today. The parties to this appeal agree that the facts are not in dispute, and this case involves a discrete issue of law. That is, whether excise tax is included as part of the purchase price of services, such as VAT, value-added tax, or GST, goods and services tax, are part of taxpayers' gross receipts for sales factor purposes. This case, as you know, has been extensively briefed. Appellants have submitted 5 briefs to respondents 4 briefs. While there is plenty of supportive case law, we believe this case simply comes down to the very broad definition of sales in the statute, California Revenue and Taxation Section 25120E. In that, sales means all gross receipts, and the California Supreme Court's affirmation of that definition stating gross implies the whole amount received. We plan to highlight the following 4 points during our case in chief. Our first point, we will give a brief background on how foreign excise taxes are levied and show how they are included as part of the purchase price invoiced and received from Robert Half's customers. And our second point, Revenue and California Taxation Code 25120E is the core of our position and the controlling statute for this issue because it defines sales. Section 25120 is also the proper statute to make any exclusion from the definition of gross receipts and is where a dozen exclusions were inserted as amendments for tax years beginning on or after January 1, 2011. California corporate income tax filing methodology defaults to worldwide filing, so foreign excise taxes charged are consequential receipts for worldwide filers. I will note that worldwide filers are likely the minority, as Water's Edge elections are prevalent. The Legislature and Franchise Tax Board had the opportunity to exclude excise taxes as part of the 2011 amendments, but did not. Thus, Section 25120 continues to require that the full amount invoiced and collected by Robert Half constitutes its gross receipts for sales factor purposes, and these gross receipts would include excise taxes invoiced as part of the purchase price of appellant services. Our third point is California case law and Board of Equalization decisions support our position because they have consistently defined gross receipts for sales factor purposes as broadly inclusive of the full amount received in transactions that generate business income. And our fourth and last point, Regulation Section 25134 also supports our position, and as a corollary, if the silence in subdivision A1C of this regulation were construed to create a specific exclusion, that part of the regulation would be in direct conflict with the definition of sales in 25120E. Now, Your Honors, we would begin our case in chief.
Thanks, Tony. As my colleague noted, I'd like to provide a little background on excise taxes on services and how they're levied in foreign jurisdictions. Excise taxes such as VAT or GST are imposed in many foreign jurisdictions as a consumption tax on the sale of goods and services. As described in the FTB's Audit Branch Procedure Statement 99-6, a VAT is an excise tax that functions very similarly to a sales tax. As applied in the context of services, where there are no discrete stages of manufacturing, excise taxes such as VAT are simply included as a line item in the purchase price, reflected on the invoice or receipt provided to the customer. To help illustrate how Robert Half International invoiced and collected foreign excise taxes on its services during the time frame on appeal, appellant has provided Exhibit A for this hearing, consisting of 4 sample invoices from 2007 and 2008. These invoices are intended to be emblematic of how VAT or excise taxes in general were collected by foreign jurisdictions. The jurisdictions included in the exhibit are Australia and Canada. And turning to the invoices themselves, you can see the computation of the service charge, the line item inclusion of the excise tax. It ranges between jurisdictions and years. In some years it's 5% or 6%. And then the full amount due under the invoice is a line item at the bottom. Generally, these, as I said, are reflective of how the excise taxes were being collected during the years at issue. As a general matter, the FTB agrees in the Multi-State Audit Technique Manual and other administrative documents that excise taxes such as VAT invoiced on the sale of tangible goods must be included in the sales factor. It is only with regard to excise taxes on services that there's any disagreement. With this background, we'd like to revisit a few of the points made in our briefs, addressing why the full purchase price of the appellant's services, including excise taxes such as VAT, constitute the appellant's gross receipts includable in the sales factor. First, Section 25120E is the controlling statute defining sales, and it requires the full amount of gross receipts received by Robert Half, including excise taxes, to be included in the sales factor. During the time frame on appeal, Section 25120 defines sales to mean all gross receipts not allocated under Sections 25123 to 25127. This statute made no distinction between sales of tangible property or goods and sales of services. Within this traditional the definition of sales from the Uniform Division of Income for Tax Purposes Act, or UDITPA, the term all gross receipts is not specifically defined by statute or regulation. However, court cases and BOE decisions have consistently given this phrase a broadly expansive meaning. The definitive case addressing the definition of sales in California is Microsoft versus Franchise Tax Board from 2006. Microsoft dealt with two issues. First, whether Microsoft's gross proceeds from sales of short-term treasury securities were includable in the definition of sales under Section 25.120. And second, whether, if included, these gross receipts would distort in-state business activity sufficiently to warrant exclusion under an alternative formula authorized by Section 25137. The issue we're concerned with here today is very similar to the first issue in Microsoft because it fundamentally deals with the scope of the definition of services, or sales, rather. The only real difference is that here both sides agree there is no distortion. It's not an issue in this case. Because Microsoft directly addressed the meaning of gross receipts for sales factor purposes, we believe the holding in that case is determinative and requires that excise taxes, such as value-added tax included in the purchase price, must be included as part of the taxpayer's gross receipts. In Microsoft, the court based its definition of all gross receipts on the plain language of the statute and prior Board of Equalization decisions. In its holding, the court wrote that for purposes of the definition of sales, gross implies the whole amount received and contemplates the total amount of money or other consideration received by a business taxpayer for goods sold or services performed during a year. The court reiterated that this definition was consistent with the legislative history of UDITPA and the definition of sales contained therein, which Section 25.120E adopts almost verbatim. Furthermore, this broadly inclusive approach to the definition of sales was noted to be consistent with Board of Equalization decisions such as the appeal of Pacific Telephone and Telegraph and the appeal of Merrill Lynch. Subsequent court cases, such as the Limited and General Mills, also affirmed this broad construction of the definition of sales. Rather than seeking to define sales by what is included or allowable, all of these cases begin with a broadly inclusive definition of all gross receipts, and then use Section 25.137 to gauge whether this broadly inclusive definition should be departed from. Turning to the appellant's facts, the invoices provided in Exhibit A illustrate that foreign excise taxes are undeniably part of the purchase price of Robert Half services. Under all available precedents addressing the definition of sales, the full amount Robert Half receives for rendering services, including excise taxes, constitute its gross receipts within the meaning of Section 25.120. I'd also like to address why Regulation 25.134 offers support for this conclusion. At the outset, no statute or California regulation states that excise taxes on services are excluded from the definition of sales. Concerning services, Regulation 25.134A1 capital C clarifies how the sales factor should operate for certain service providers. The regulation simply states that in the case of a taxpayer engaged in providing services such as the operation of an advertising agency or the performance of equipment service contracts or research and development contracts, sales includes the gross receipts from the performance of such services, including fees, commissions, and similar items. This language helps provide clarification of what is included in the sales factor in certain circumstances, such as advertising services, equipment service contracts, and research and development services. No language in this subdivision of the regulation reads in an exclusionary or limiting manner. In fact, concerning the few types of services mentioned in subdivision A1 Cap C, the regulation is permissive in its inclusion of fees, commissions, and similar items. The limited types of services mentioned in this regulation are described inclusively and as applied or as analogous to the appellant's staffing services. The available guidance in subdivision A1C of Regulation 25.134 supports that excise taxes included within the purchase price would be included in the sales factor just the same as fees, commissions, and similar items for the types of service providers described in the regulation. It's also worth noting that the California Supreme Court has explicitly rejected attempts to interpret silence in the regulation 25-134 in an exclusionary or limiting manner. Specifically, as a backup position in Microsoft, the FTB attempted to argue that because Regulation 25-134 A1 Cap A mentions all interest income but is silent on the return of principal from sales of securities, that by negative implication, silence means that the principal sales price is excluded from the definition of sales. The California Supreme Court rejected this argument and refused to read silence in Regulation 25-134 as a sales factor exclusion. Rather, the court construed this regulation as including interest income in addition to amounts not specifically mentioned in the regulation. In part, the court wrote, "It does not support a reading of gross receipts that includes interest but excludes the principal sale price." In this regard, the court was clear that the silence in Regulation 25-134 does not impact or limit the definition of sales in Section 25-120. As a related matter, a thorough review of the rulemaking file on Regulation 25-134 shows there is no mention in any part of this of the rulemaking file about Subdivision A1 capital C being intended to operate to exclude excise taxes on services. And this makes sense because the underlying statute, Regulation 25-134, is not the statute defining sales. Instead, it is Section 25-120 that defines sales, and the judicial interpretations of that statutory definition are what determine whether the receipts at issue are includable in factor. I'll turn it back to my colleague.
Appellant would also like to address respondents' contentions in its briefs that, quote, "Nothing in Microsoft says that VAT is includable as a gross receipt," unquote, and that, quote, "The legislature must amend the underlying statute to include VAT in the sales factor." We submit that respondents' proposed approach to the definition of sales is simply contrary to both the legislature's and court's interpretation of the UDITPA definition of sales. This definition has been interpreted as the whole amount received, and more recently, to list the specific exclusions now contained in Section 25-120F. Thus, the term all gross receipts would require the inclusion of excise taxes on services unless one of two things happens. One, there is a specific statutory exclusion, or two, such receipts are distortive, warranting application of alternative apportionment under 25-137. With regard to number one, statutory exclusion, the Franchise Tax Board is very good at writing regulations, and they know how to write an exclusion into a rule. Silence is not an exclusion. And with regard to point two, both parties, as you mentioned, Your Honors, both parties agreed in briefing that sufficient distortion does not arise in this case. Alternative apportionment is not triggered. We like to think of alternative apportionment as a safety valve when something's out of whack. And in this case, that safety valve isn't triggered. I believe the difference in the sales factor in 2008 was about 1.5%. Thus, nothing out of whack, so the alternative apportionment is really not an issue as we discussed, and it comes down to that first issue in Microsoft, is this a gross receipt? Respondents' narrow construction of gross receipts was rejected by the California Supreme Court in Microsoft and similarly rejected by the State Board of Equalization in decisions including appeal of Polaroid Corporation and appeal of Bechtel. While non-precedential, the SBE gave us helpful language in Polaroid in that, quote, "The plain meaning of gross receipts appears to be quite expansive, and because no California case or regulation has narrowed the definition of gross receipts, there is no authority to look behind the term's plain meaning." In appeal of Bechtel, the Board of Equalization also stayed true to this theme, stating, quote, "We find that the level of income-producing business activity to be represented by the sales factor is best represented by inclusion of the full amount of the cost-plus contract. Additionally, the definition of sales has never been limited to a list of categories of gross receipts approved by the legislature or the courts. Consider that when the legislature amended Section 25-120 in 2011, they did not enact a narrow definition of gross receipts and then add a laundry list of receipts categories to include. They did the opposite. They added a broadly expansive definition of gross receipts, paralleling Microsoft, and followed that with a dozen specific exclusions, none of which mentioned VAT or excise taxes. They could have excluded VAT then, and that would have been the time and place to do it in Section 25-120F. If, as respondent asserts, the statute must be amended to include VAT on services, then every newly invented revenue stream concept would also require statutory amendment before inclusion in the factor. Consider blockchain and cryptocurrency revenue. There is no specific inclusion for these items. Such an approach would be burdensome to administer and lead to absurd results. The original UDITPA definition of sales was broad for a reason and was designed to promote uniformity among the states. In wrapping up our case in chief, we agree with the Franchise Tax Board that the sales factor should include excise taxes on goods charged to and received from the customer. We disagree, however, that excise taxes on services should be treated any differently. There is no meaningful difference between an excise tax on goods versus an excise tax on services. Nowhere in the law is there an exclusion of excise taxes on services from the sales factor. The Franchise Tax Board knows how to write exclusionary language, and silence in Regulation 25-134 is not an exclusion. The statute, Section 25-120, and the case law, including Microsoft, confirm the broad definition of sales is all gross receipts and the whole amount received. Thus, excise taxes on services should be included in the sales factor. This concludes appellant's case in chief.
Thank you. Franchise Tax Board, you'll have 30 minutes whenever you're ready to start, Ms. Williams.
Okay, thank you. In its original return, appellant included foreign value-added tax, what we've been talking about, VAT, from sales of services in the denominator of its sales factor. At FTB audit eliminated the VAT from appellant's sales factor. There is no statute, regulation, court precedent, or other authority that provides that VAT on services is a gross receipt, includable in the sales factor in the California apportionment formula. VAT is permissibly includable as a gross receipt in the sales factor where there is a sale of tangible personal property. This is pursuant to Regulation 25-134A1A, and I'm going to read it to you. In the case of a taxpayer engaged in manufacturing and selling or purchasing and reselling or goods or products, sales includes all gross receipts from the sales of such goods or products or other property of a kind which would properly be included in the inventory of the taxpayer if on hand at the close of the income year. Held by the taxpayer primarily for sale to customers in the ordinary course of its trade or business. Gross receipts for this purpose means gross sales, less returns and allowances, and includes all interest income, service charges, carrying charges, or time price differential charges incidental to such sales. Federal and state excise taxes, including sales taxes, should be included as part of such receipts if such taxes are passed on to the buyer or included as part of the selling price of the product. Conversely, according to Regulation 25-134A1C, VAT is not included as a gross receipt when it is a sale on services. And I'm going to read that section much shorter to you. In the case of in the case of a taxpayer engaged in providing services such as the operation of an advertising agency or the performance of the equipment service contracts, research and development contracts, Sales includes gross receipts from the performance of such services, including fees, commissions, and similar items. Based on my reading of the subsection 25134C1C, there's no intention of including the VAT on sales on services. That language is absent in that provision. It's not absent in C1A, but it is absent in C1C. The language just isn't there. So why isn't the language there? Well, when 25134 was promulgated by FTB, there existed a sales tax for tangible personal property that balanced inclusion of foreign VAT on sales of tangible personal property. However, on the side of sales of services, Regulation 25134A1C, there was no comparable sales tax on services, and therefore there could be no symmetry for services as there was for tangible personal property. So in connection with Regulation 25134, what are the rules when construing regulations? I've got about 6 to talk about. Number 1, give the ordinary meaning to the words. Appellant calls this a strained reading. Number 2, if there is no ambiguity, the presumption is that the rule makers meant what they said, and the plain meaning of the words govern. Insertion of the word VAT is clearly inappropriate. 25134A1C is intentionally and specifically silent on VAT, on services. And I want to point out, unlike appellant's argument, respondent's interpretation of that subdivision does not alter or enlarge that regulation. It doesn't add to it. We just read the plain language and stop there. Number 3, a specific regulatory provision is considered to be an exception to a general regulatory provision. But 134A1C is not an exception to the general rule. It is its own provision of equal weight, just like Regulation 25134A1A. When construing administrative regulations, an agency's expertise with respect to pertinent and regulatory issues lends presumptive value to interpret the regulations. Long-time consistent interpretation by an agency is given great value to the regulation interpretation. Weigh in favor of more deference where there has been compliance with AP rulemaking, which there was in connection with 25134. Appellant says it's not given as much authority as when a regulation is directed or authorized approval by legislature. However, I want to point out that there is no other authority on this matter. 25134 is the statute and regulation of sales of tangible personal property and services. It is the sales factor. It is not subservient in its operation to 25120. They must be read in harmony. Regulation 25134 is well within respondents' expertise, since it was our agency that promulgated that regulation. Therefore, this is number 6, respondents' interpretation of Regulation 25134 is presumptively correct. The provisions of subdivisions 25134A1A and C are clear, and that 2 subdivisions, when taken together, are not ambiguous because each applies to a different situation. 25134A1A applies by its terms to taxpayers engaged in manufacturing and selling or purchasing and reselling or goods or products, while 25134A1C applies to taxpayers engaged in providing services. Appellant makes numerous arguments. I'm only going to address some of them here. First, contrary to what is stated otherwise in Regulation 25134, appellant makes the argument that Regulation 25134A1A and C do not define gross receipts, and that only Code 25120E does. However, I want to point out language in 25134A1 that states sales are governed by Code 25120 subsection E, and that Regulation 25134A1 provides, quote, rules for determining sales in various situations, end quote. Second, appellant argues that 25120E and Microsoft control the interpretation of gross receipts and somehow justify adding the words value-added tax to 25134A1C, which, as I stated earlier, those words do not exist in that regulation or in that subdivision of that regulation. Microsoft is not about 25134 at all. It is about Code Section 25120 subsection E. And Regulation 25134 is not about Code 25120E, but it is about the sales factor in general. It is the sales factor statute and regulation, and how to determine sales in connection with tangible personal property and services. By its own terms, Regulation 25134A1 explicitly states that it provides for situations involving the sales of tangible personal property and sales of services. Microsoft deals exclusively with gross proceeds from Treasury Department operations in the sales factor. Microsoft does not provide guidance in this VAT case. Contrary to appellant's argument, Regulation 25134C A1C does not conflict with Code 25120 subsection E. Code and Regulation 25134 is about the sales factor generally, and Code 25120E is about gross receipts. They act harmoniously together. Appellant argues that 25120E unambiguously requires all excise taxes, including VAT, be included in the sales factor. But Code 25120 subsection E does not mention VAT. And the definition of gross receipts under Code 25120 subsection E is not an open-ended depository of income. Code 25120E, in fact, excludes certain items as gross receipts, including repayment of the principal on a loan, pension reversions, hedging transactions, litigation, just to name a few. Third, appellant points to 25134A1C, where it says sales includes the, quote, sales includes the gross receipts from the performance of services, including fees, commissions, and similar items. Appellant argues, quote, similar items, end quote, is permissive language to be interpreted as including VAT. There is no reasonable interpretation that similar items is a reference to VAT. Similar items is a reference to fees and commissions stated a few words before. VAT is not fees, commissions, and similar items. Fourth, appellant argues that Regulation 25134A1C is not an affirmative exclusion of VAT. Taking appellant's argument to its limits, you could say that anything is includable in 25134, including non-business income, because appellant argues there are no affirmative exclusions in Regulation 25134A1C. Fifth, appellant also points out the 2011 legislature amended the definition of gross receipts and did not include any mention of VAT when they did that. When amending on Code 25120 subsection E, the California legislature did not comment on Regulation 25134. By not mentioning VAT in either code sections 25120E or 25134, the California legislature was affirmatively confirming that treatment that is implicit in Regulation 25134, that VAT on services is not includable in the sales factor. Sixth, appellant states that in its brief that the legislature did not limit the inclusion of VAT in the sales factor. Conversely, the California legislature did not include VAT as gross receipts either. Seventh, appellant also asserts that an internal memo issued to respondent's auditors 20 years ago, and this is the Audit Branch Procedure Statement 99-6, is controlling. I think we need to read that, and I have it right here. This is actually attached to appellant's opening brief as Exhibit K. Issue. Regulation 25-134 A1A, not C, A1A, states in part, quote, federal and state excise taxes, including sales taxes, shall be included as a part of such receipts if such receipts are passed on to the buyer or included as a part of the selling price of the product, end quote. In regards to the value-added tax, VAT, charged by many foreign countries, the issue of inclusion of the VAT in the sales factor rests on the definition of federal and state and the determination if the VAT is an excise tax. That says nothing about 25-134C1C. It says nothing about services. It mentions product as part of the selling price of the product. Clearly, it's only talking about 25-136 subsection A1A. And with that, I rest.
Thank you. Appellant, you have 10 minutes to provide a rebuttal.
Thank you. Can I steal this back?
Yes.
I think I would start by reading section 25-134. So regulation section 25-134 modifies the statute 25-134, which is one sentence. And I'll read it. The sales factor is a fraction, the numerator of which is the total sales of the taxpayer in this state during the taxable year, and the denominator of which is the total sales of the taxpayer everywhere during the taxable year. So 25-134 says that the sales factor is a fraction. It is section 25-120 that provides definitions. It is the definitional section. It defines sales. That was modified in 2011, but the purpose of the statute 25-120 is to provide the definitions and the definitions of sales. And even the regulation, Ms. Williams just read, refers to 25-120E as defining the term sales. It makes that reference. We respect the Franchise Tax Board's ability to write regulations very much, and we do not believe the way that we think that the regulation 25-134 should be interpreted, that it is invalid. We think it is valid. We do not think the way it's written, we do not believe that it limits 25-120. If it were interpreted to limit 25-120, we would think then that it has exceeded rulemaking authority and it would be invalid. But we do not believe that it is doing that. I think it is more likely that simply when this section A1A versus A1C was written, VAT on services was not considered. We believe it was an omission. I was involved in the 90s when I believe the Franchise Tax Board was looking at VAT in the sales factor as a first impression. We had a case, and I was impressed. It was young in my career, but I was impressed by Franchise Tax Board. They dedicated some significant resources in looking at the issue and asked us to provide a European VAT expert to answer questions and help them understand. So they invested time and spent money really looking at this issue, and I think did a good job. At that time, it was a VAT on goods, and I think that's more common. And because California doesn't have a sales tax on service, a broad sales tax on service, they have I think a limited sales tax on services. It just was something that was not forefront, was not considered, is probably not as common. But that doesn't change. That doesn't create an exclusion in 25-120, which has been consistently broadly interpreted. It has broad language. It has consistent broad interpretation. To create an exclusion would be a significant step, and there's nothing in the language, as we've discussed, there's nothing in the language of 25-134 that should be read as an exclusion. if anything, it's written in a broad manner to potentially have a sweeping inclusion, and similar items is not, to me, the type of language that you would put in to create an exclusion. It may not specifically address VAT, but again, I don't believe VAT was part of the consideration. My colleague can discuss in a moment a little bit more about the rulemaking in the regulation. One more point I'll make before I pass it over. As far as non-business income, Ms. Williams mentioned non-business income isn't addressed. It is now addressed whether it's required to have a transaction generating business income for a receipt to be included in the sales factor today. That was added in the amendment to 25-120 in 2011. It was not an amendment to 25-134. The proper place to amend the definition of sales is in section 25-120, and that's where it took place.
On that topic, I would also clarify that independent of the 2011 amendments, the prior definition of sales, if you look at the language, it limits itself to gross receipts from transactions other than those governed by 25-123 through 25-127, which are the non-business allocation statutes. So by the language of 25-120E, as it existed during the years in question, it could never contemplate transactions generating non-business income. I also I did briefly want to revisit the history of the 25-134 regulations. That it was adopted in two pieces, the first part in 1971 and the second part in 1973. And I think at the time, it's probably reflective. When we review the rulemaking file, we don't see any mention of excise taxes or excise taxes on services. It seems to have been motivated by an effort to promote conformity between states adopting the UDIPA definition of sales. I think that the difference in language is probably the most reasonable explanation is the relative uncommon nature of excise taxes on services domestically at that time. And I don't think reading silence in an exclusionary manner has ever been countenanced by courts interpreting the definition of sales. I mean, just to reiterate, as I had mentioned, 25-134, the statute, it simply defines the sales factor as a fraction. When courts have been interpreting what is or is not a gross receipt, they always look at first section 25-120 and whether it is within the definition of all gross receipts, and I did want to revisit that. I think to the extent that silence were given any meaning, which we don't believe it should be, but even if you did go down that road, the linguistic differences would have been overridden by the Microsoft decision's interpretation of the definition of sales in 2006, which is several decades after the regulation was adopted in the early 1970s.
I think that concludes our rebuttal.
All right, thank you. Next, we'll go to questions from the panel. I will start with Judge Gast.
Thank you. Thank you for the presentations, by the way. They were both really, really well done. I think I'll start with the taxpayer with questions. Why shouldn't we give FTB's regulation 25-134 A1C, their interpretation of it, to exclude VAT deference? They've applied it, seems like, consistently. It's been in their audit manual for a while, I think. So why shouldn't we just give them deference on that?
Yeah, sure. No, I think that as 2 points. The first point is when looking at the rulemaking file, I think looking at the history contemporaneous with its adoption illustrates that interpretation was not contemplated at the time of adoption. That would be my first point. And I think my second point would be that as an interpretive regulation, so this is not a quasi-legislative regulation, the difference being there's no specific legislative grant of rulemaking authority like you would see in 25-136 that says, please promulgate regulations. This is under general interpretive authority, which is owed less deference than specific quasi-legislative grants of rulemaking authority. So that's the starting point of the type of regulation we're dealing with. And then when you go from there, when you look at cases like the appeal of Save Mart or the Yamaha decision from the California Supreme Court, they frequently compare the language of the regulation with the statute that it's trying to interpret. And when doing that, they look at the validity of the reasoning behind what the differences are between the regulation and the statute. So here, if you put the language together side by side, you see that the statute itself does not define sales. It simply defines the sales factor as a fraction. And when you think about the analysis in the appeal of Save Mart, where they look to whether it expands and alters the language of the statute, I think you reach the inexorable conclusion that the 25134 regulation would be a broad expansion of the 25134 statute, which has nothing to do with the definition of sales, which is contained in a wholly separate statute.
Okay. But let me ask you this. When you're saying that under A1, 25134A1C, a VAT and GST wasn't contemplated at the time, aren't you asking us to read into it, to read into that provision a VAT that is contemplated that never was there by the drafters, here FTB or the MTC? Can we do that?
I think it's the way you think of the concept. If you take respondents' argument that the definition of gross receipts is narrow, and every item of receipt needs to be listed. If you don't have a list of includable items, you don't have a receipt. Then I think what you said about the fact that 25134A1C does not mention VAT, that would be valid. But I give you the premise that it's the opposite of that. What we have and what's workable, because of it was the framers of UDITPA that wrote all gross receipts. We're starting with a broad all gross receipts. You can't have the foresight to know what all the different revenue streams of gross receipts are going to be. So you start with all of them, and if something doesn't make sense, you exclude it. And we believe that that's what should happen. That is what has happened. And excise taxes have not been excluded. They were specifically included for sale of goods. They were not addressed in services, and there's no meaningful distinction between the two.
To build upon that, I think I would add that the language of 25134A1 Cap C is addressing services in certain limited circumstances. I believe it mentions 3 types of services. I don't think, taken to its logical conclusion, if you read silence as an exclusion there, you run down the gamut of anything not listed becomes excluded. And I think the risk there is that would operate to reverse the definition of sales that courts and the Board of Equalization have been following since the late 1970s.
Well, and to follow on what he just said, in the regulation it lists 3 types of services. And if you were to read that literally, that only 3 types of services should be included in gross receipts, I don't think anybody here would think that would be the proper result.
Okay. Since this is an MTC regulation that was adopted by FTB, is there any other state out there that has dealt with this issue?
I think when you say dealt with this issue, do you mean that has a excise tax on services, or that has...
Yeah, how they've treated this issue, because I think other states have a similar regulation.
Right.
So what have they done, if anything?
You find similar language in many state regulations, because I think at the time many states were adopting that model regulation, the UDIPA regulation we find in 25134. Again, as a general matter, that was happening back in the 70s when there just wasn't a great prevalence of excise taxes on services. Surveying the states out there, we haven't seen anybody speaking directly to this particular issue. I think it stems from that these model regulations were often adopted at a time when people weren't thinking about whether excise taxes on services were contemplated.
Okay, thank you. I have a few questions for FTB. My first is, if Regulation 25-134 contains the exclusive definition of what gross receipts means under 25-120, why did Microsoft and General Motors and General Mills have to even discuss whether the treasury receipts at issue in that case were gross receipts to begin with? Why couldn't they just go to 25-134 and say, oh, here it is, it's a gross receipt?
Well, the statute for the definition of gross receipts is 25-120E, and that's what Microsoft was part of, et cetera. I wasn't trying to say that the 25-134 provided a definition of gross receipts. It provides a method of assigning sales of tangible personal property and services. It doesn't get into gross receipts. It does say that for tangible personal property, excise taxes definitely include them, but it doesn't say that receipt. That's not an omission. That's not a mistake. It's just not done at the time because of the lack of symmetry. Because we don't tax services.
Yeah, I understand.
If I may, your question, if I may restate it, is basically why is Microsoft, General Mills, and the other case you mentioned, they did not address 25-134, correct? They seem to exclusively focus on 25-120E. You're correct. Within respect to those cases, the overall issue was what is a quote-unquote gross receipt. In this case, we have additional rules. And the additional rules are the additional rules that on their face appear to be controlling. Those are what we've addressed before, 25-134C1A and 25-134C1C. They're validly promulgated regulations that on the face appear to be applicable. In those cases you mentioned, Microsoft, General Mills, whatever, they were not applicable, so there was no need to address them in those cases. So what we're looking at here, what's the gist of this case basically comes down is 25C1A and 25C1C, you understand.
By 134, yeah.
Are they controlling in this fact pattern regarding the VAT? No question, Microsoft, General Mills was a discussion in an abstract sense about what is a gross receipt for sales factor purposes. Arguably, this does qualify what is a gross receipt, even though it's embedded in the sales factor rules, not the gross receipts rules. But nevertheless, it is still applicable. It cannot, C1A and C1C cannot be ignored.
So I'm a little confused by what you said on the last part. You're saying Microsoft made a distinction between gross receipts and sales?
In Microsoft, as you know, the issue was treasury function.
Right.
And they were selling and buying short-term investments. And the question was whether or not the principal in the investment transaction should be reflected in the sales factor denominator or not. So the issue really, what 25-134 was not the focus of Microsoft. What was the focus in Microsoft was about the gross receipts. Specifically, the rules that were at a contention in this case were not applicable in Microsoft. That's why they weren't addressed. Today, we're focusing on C1A and C1C because they appear to have applicability with respect to the VAT being reflected in gross receipts, which is gross receipts or sales. Sales are what comprise the sales factor.
Okay.
It just wasn't an issue in Microsoft.
But why couldn't they just point to 25-134 and say, redemption of marketable securities? Oh, that's a gross receipt. They couldn't do that in that case. Is that what you're saying?
I can't answer as to why the court did not do that or why that wasn't briefed.
Okay.
Pardon me. I mentioned that in my case in chief. It was briefed, and they tried to argue that because it doesn't explicitly mention the return of principal, that it should be excluded, and the court rejected that.
Was that in the context of interest income, though?
It was, so I pulled out the case. The argument was that because 25-134 A1 Cap A mentions all interest income, that it should be interpreted to only contemplate that and not the return of principal. That argument was rejected.
Fair.
Then I stand corrected.
I think, okay, one more question for FTB. If you could clarify what you were talking about in your presentation with 25-134 A1C about how the use of the word similar items is not a VAT, but could you also address why that reg subsection uses the word includes? Doesn't seem like it's an exclusive list.
It may not be, but the language that they've tried to very respectfully hang their hat on to include VAT is that third item in that provision. I'm sorry, I have to get my glasses on. And it says, and you're right, it says includes, it doesn't say excludes, but it's only including fees, commissions, and similar items. Fees, commissions are not VAT, are not excise taxes. They're entirely different animals. And so my point was similar items doesn't hook on with VAT because you've got fees, commissions, and similar items. So they got to be similar to fees and commissions.
Okay.
Does that make sense?
Yes, that makes sense. Thank you.
Okay.
One more question, actually, and this is for the taxpayer here. If we rule in your favor, what does that do for 25-120 F2 in 2011 going forward? Does that affect whether VAT's included under that new definition for gross or amended definition for gross receipts going forward, or is this just limited to prior to 2011? That makes sense.
I think it does.
I guess as a practical matter, it's an interesting question. It's a good question. Two things come to mind. I think the first is that the structure of the amendments, it borrows from the broad definition of sales in Microsoft and then builds in, a number of limited exclusions from the definition of gross receipts. Because none of them mention excise taxes on services, I would postulate that the law would be the same before and after, unless and until a specific exclusion were codified. I think that's the first thing that comes to mind.
But if I may interject there, isn't it tied to what's recognized for federal income tax purposes? So would we have to go down a path in this case of saying...
You're right, Your Honor. It is tied to receipts related to a transaction that is recognized and generates business income. So it's not the receipt itself, that it's part of a transaction that is recognized in the year. That's the timing, so that the sales match up in the correct year with timing. It also needs to be realized, so there's a completed transaction. Those are elements in it. I don't think that would change the result here. And I think just to back up a little bit, we disagree with respondents' characterization that we're hanging our hat on 25-134A1C in the regulation. We're hanging our hat on 25-120E and now the fact that F does not include it. So I think that does get to your question. We start with a broad definition of sales, and and that would include excise taxes because it's not excluded in 25-120. I think if you held in our favor, that would reaffirm that. I don't think that the regulation 25-134 contradicts this because there's no explicit exclusion in there. There's some clarifying language that is helpful when should excise taxes on goods be included. That was it was a much more common scenario, so it's providing guidance to taxpayers that have the issue. Yes, that should be included. I don't believe it was contemplated for services because it doesn't come up very much. It's starting to more, and California California has a bill right now. They've had 4 over the last decade, but they have a pending bill right now to potentially enact a broad-based sales tax. So it's failed 3 times before, but it seems like this keeps coming up and it keeps getting closer. I don't, if we're talking about symmetry, I wouldn't think that if California were to enact a broad-based bill imposing sales tax on services, that should change the result. Like suddenly, if we have symmetry, it should be included versus excluded. So I think what we need to give deference to the statute and the case law interpreting it, and I think
I would say under our interpretation, it would be, I think, fairly clear that if a bill like that passed, those amounts would be, to the extent delivered to California customers, would become included in the numerator.
Okay. But going back to my question, was VAT included in gross income for California franchise tax purposes during 2008 on the return? Is that technically how it's supposed to work, and then you get a deduction?
Well, VAT, we understand what would happen is so VAT would be an expense incurred by Robert Half. They are not required to charge their customers for the VAT. If they did not charge their customers, their profits would decrease. So it would be a cost against their margins on providing services. If they do charge it, what that does is that increases the profit margin on that sale. So in that sense, it's part of the...
So that would have been reported on line 1C of the California return? Or, I don't know, maybe you don't know. That's okay.
It would not.
It would not. Okay. All right. That's all the questions I have.
Thank you, Judge Guest. Judge Njija.
I have 2, both for Franchise Tax Board. The VAT is the same substantively. It's charged on the invoice, passed through to the customer pays it, and the taxpayer receives it. What's the substantive difference for that being included in gross receipts when the underlying transaction is a sale of TPP compared to when it's a sale of a service?
What's the substantive difference?
If it's gross receipts for one, why is it not gross receipts for the other when they're functionally the same thing in both instances?
Functionally, the point is that it goes back to the symmetry issue. For the years at issue, California would not have had an excise tax, a VAT, whatever, on the receipts pertaining to services. So what you're going to have is look, the numerator, the sum of all the numerators in the sales factor of all the jurisdictions is supposed to equal the denominator. What you're going to have is you're going to have a denominator without numerator reflection. You're going to have that, and so that's the lack of symmetry.
Okay. The other question, they mentioned the cryptocurrency. I thought that was interesting that nobody addressed it after that. So I don't know if it was just illustrative, but 25134A1C doesn't mention cryptocurrency, Bitcoin. So if that were the gross receipts from a sale of service, would that not be included either?
I can't respond to that because you're talking like Bitcoin. Is Bitcoin a service or a product?
It's consideration for the payment of a service that's not listed in 25134A1C.
No, we have not. We're addressing that issue. We are investigating that issue. So it's a little before our time.
All right.
If you know the answer, I'd love to hear it. I mean, it's a burgeoning issue.
I was intrigued with the example, so I wanted to hear the answer. So I have no further questions.
Okay, thank you. I have a couple questions. I'll stay with Franchise Tax Board. I know Appellant discussed for a little bit the potential for California law change that would possibly include a VAT on services or a tax on services. If that were to happen, from your perspective, would that change the policy arguments and the concern about symmetry?
So you're saying that there's a proposal, or I heard you say, could you repeat that? In Los Angeles, there's a...
Oh, no, sorry, just in California, if there is a excise tax on services, would that change the sort of policy arguments and symmetry?
Then you wouldn't have concerns about symmetry.
Okay. All right. And then I'll change it here and do a simple question. Franchise Tax Board, do you have any arguments over the calculation of the VAT that the taxpayer claimed?
No.
Okay. And for Appellant, did you collect any VAT on sales of TPP, or is it entirely services?
There may have been some incidental TPP software. If some countries consider that tangible property, we would have collected that on that as well. But in general, we do not sell any tangible personal property.
Okay, so if there was, it was incidentals.
Yes.
Okay. On some of the sample invoices you provided, I believe it was the Canadian ones. It says GST/TPS. Is TPS French equivalent? I'm not familiar with what that is.
I believe it's the French equivalent, correct.
Okay.
I did one of the things that was said was fascinating about the numerators should add up to the denominator. I did want to flesh that out a little bit. I mean, it's a fascinating concept. I think if you're dealing with a Water's Edge filer, that there is some logic there, but with a worldwide filer, I don't know that it would be the case that the numerators would add up to the denominator. I mean, if you extrapolated a U.S. domestic taxation system onto foreign jurisdictions, it would, but many of I would assume most of them do not have the same apportionment concepts we do.
Thank you. And last question is going to be for both. I'll start with appellant who might answer it. But originally, all the briefing deals with VAT, value-added tax, which I believe is just being used as part of the general term of this excise tax on services. Just so that I'm clear, that's going to include a decision that we make on VAT would include anything of goods and services tax as well, right?
It's a great question. I was figuring somebody was going to ask that. The nomenclature of these excise taxes varies from country to country. I think you frequently see them as it's one tax by multiple names. The different terminologies aside, the most common are either a VAT or a GST, so it would encompass both.
And Franchise Tax Board, is that correct on your side as well?
I don't know.
If it helps, some of the audit work papers, when they were
Yeah.
verifying the amounts, were using the term. Both
Okay.
terms.
Okay. I have no reason to disbelieve
Okay, thank you.
Mr. Grossman.
Let me check one more time with the panel, see if any new questions have arisen. Judge Gast?
No further questions.
And Judge Njija? No. All right. With that, we'll go to our closing arguments. Each side will have about 5 minutes to provide a short closing. Franchise Tax Board, we'll start with you, Ms. Williams.
All right. First, I want to say that the 25134A1C, the VAT is not an omission. It was intentionally left out for symmetry reasons. And I'd also like to close with appellant misreads Regulation 25134, making assumptions that are misguided and probably inappropriate about a Regulation 25134. And appellant also is attempting to impermissibly broaden the definition of gross receipts under Code 25120, subsection E. And with that, I close.
Thank you. And appellants?
First, I wanted to thank everybody for their attention in this matter. The first time in front of the OTA, it was truly a pleasure, and I just wanted to say thank you as an opening. To Melissa's point in her closing, that I did want to emphasize that nothing in the rulemaking file suggests that the omission of excise taxes on services within the 25134 regulation suggests it was intentional. We didn't see anything in the rulemaking file suggesting that was the intent at the time. The issue in this case remains a straightforward issue of statutory interpretation. Section 25134 and its related regulation are not the controlling authority in this case because it is Section 25120 that defines sales. Revenue and Taxation Code Section 25120E plainly defines sales to include all gross receipts. The California Supreme Court's Microsoft decision broadly construed this statutory definition to mean the whole amount received in transactions generating business income. Similarly, decisions of the Board of Equalization stretching back to the 1970s have approached this definition of sales in a broadly inclusive manner. Simply put, many of those cases, such as appeal of Pacific Telephone and Telegraph or Merrill Lynch could have been decided on other grounds, but they weren't. They started with a broadly inclusive definition of gross receipts and then analyzed whether that should be departed from. I think with this history in mind, if respondents' attempt to narrow the definition of sales in this case were upheld, it would reverse approximately 4 decades of consistent California precedents construing the definition of sales for apportionment purposes. Thus, as a basic matter of statutory interpretation and stare decisis, the appellant's original return position must prevail, and the FTB's attempt to narrow the definition of sales, which directly contradicts the holding in Microsoft, must be rejected. Accordingly, the appellant respectfully requests that the OTA reject the FTB's adjustments to exclude excise taxes from Robert Half's sales factor. Thank you.
Thank you. With that, we have your evidence and your arguments and your briefs. We've heard your arguments today. We have a complete record on which to base our decision. I wish to thank both parties for appearing on appeal and providing the briefs and exhibits that you have thus far. The record is now closed. This will conclude our hearing on this appeal. The judges will meet and decide the case based on the arguments and evidence presented. We will aim to send both parties our decision no later than 100 days from today, June 5th, 2019. With that, we are now off the record. June 25th, 2019. With that, we are now off the record. This concludes our hearings for today, and we are adjourned. Thank you.
Thank you.
Thank you.